Hello, everyone. Welcome to my class in Accountancy, Business, and Management. Today, we will be discussing Fundamentals in Accountancy, Business, and Management 1, simply Accounting 1. Last week, we studied the rules on debit and credit. Okay? Today, we will apply these rules on a real problem that I will be presenting today. Then we will be preparing the journal entries, and then we will be posting the journal entries to the ledger. And then maybe next week we will be doing the financial statements, okay? The balance sheet and the income statement. So for today, okay, the next slide is, okay. Again, I'm repeating here a slide on the rules of debit and credit. You will notice the letter T, okay? That is the color blue, okay? The letter T. On the left side of the letter T is your debit. Debit, below the debit are the following accounts: asset or assets, cost, expenses, and drawing. These asset are the normal debit balances accounts. And these leaks are the normal credit balances accounts. Leaks means liabilities, income, capital, sales. Let me repeat. The assets, costs, expenses, and drawing, they do have normal debit balances. Okay, let us memorize it. Okay, then the leaks or the liabilities, income, capital, and sales, they do have normal credit balances. Okay, now let's go to the example. Okay, transaction number one. Ben invested 1 million cash to XYZ Company. Okay, let us recall again. When when we are facing a transaction, okay, what is the first thing that we need to take into consideration? Number one, what are the accounts used? So, what are the accounts used here? Cash and investment is a form of capital or equity. Okay, so cash and capital or equity. Then, number two, what? How did the cash and capital affect the XYZ company? Okay, how did it affect the XYZ company? Okay, in this case, Ben invested 1 million cash to XYZ company. Then we will analyze it by, again, cash is a form of what? Asset. Okay, we have studied that in the past weeks. An example of asset is cash. And cash has a normal debit balance. Okay? So because that was a normal transaction, we will debit cash and credit the capital. Okay? Capital has a normal credit balance. Do you get it? Okay, I hope you are following. I'm doing this very slowly. So Ben invested 1 million to XYZ company. I said, what's the first thing that you will ask yourself? What are the accounts involved? So we know now from this journal and from this transaction, the accounts involved are cash of 1 million and an investment or capital or equity of 1 million. So you debit cash because cash is an asset with a normal debit balance, and we credit capital, Ben, comma, capital or Ben equity, that is also correct. We credit it because capital has a normal credit balance. And your debit is always equal to your credit. So 1 million in your debit, 1 million in your credit. Okay, you get it? Yes. Okay, number two, transaction. Oh, wait, I will now be showing you here the T account. We will immediately prepare a T account so that you will not be confused. Okay, so because the accounts involved are cash and capital, so where did we put cash? On the debit side. So we post the 1,000 on the debit side of the account title cash. Okay, then We post again on the Ben Capital, that's a capital account with a credit balance. So we credit 1 million. Okay, next. Transaction number 2. XYZ Company borrowed 500,000 to ABC Bank. Again, what is the first consideration? What are the accounts involved? Cash and what else? When you say you borrowed, that means you have a payable to the bank. You borrowed money, that means you have a liability. A liability in the form of a notes payable. Why notes payable? Because when you borrow to a bank, you normally sign a promissory note. Okay? So in this case, what are the accounts involved? Okay, now let's go back to the rules. When you borrowed money, what is the effect to XYZ Company? Correct. XYZ Company will receive cash. Okay, when you borrowed money from the bank, you will receive money from the bank. And money or cash is an asset account which has a normal debit balance. And when you borrowed money to ABC Bank, what is the effect to your credit side? Correct. You will have a liability. You will have a liability to ABC Bank. And what form of liability is that? Okay, let's see the journal entry. Okay, since you will receive cash from the ABC Bank when you borrowed money, you debit cash because you received cash. Okay, and you credit notes payable because you incurred liability. Cash has a normal debit balance and liability has a normal credit balance with the same amount, 500,000, 500,000. Okay, you may notice that the debit and the credit has is indented. Okay, well that is only to show the difference. But in the real, when you are already using the software in accounting, what you will do is to analyze only and then put it on the computer, it will compute for itself. But still, your analysis is very necessary because you will be the one to input on the software what is the debit and what is the credit account and what is the amount involved. Okay, as we have said, your debit must always equal your credit. So, debit cash of 500,000, you credit liability of notes payable ABC Bank 500,000. Next, we have, okay, so again, we have the T account cash. We put it on the debit side because you received cash. And cash is a debit, no, cash is an asset account with a normal debit balance. So you debit cash on your T account and then you credit notes payable ABC Bank. Liability notes payable is a liability account which has a normal credit. So you see, it's written on the credit side of the T account. Next, third transaction, sales of 2 million was reported to XYZ Company. Again, what's the first consideration? What are the accounts involved? So when you say sales, well, the company received sales or the revenue. And then when you receive sales, meaning you also receive cash. Okay, when you acknowledge your sales in the form of cash. And what are the accounts involved? So meaning the accounts involved here are assets, okay? Assets, cash. Cash is an asset account. So asset has a debit balance or cash, and the credit side, sales has a credit balance. Look at that. Sales here below, sales here has a credit normal balance. So what do you do with the entry? Very good. You debit cash because you received 2 million in cash and you acknowledge your sales on the credit side because you recognize the sales with an amount of 2 million. Now you're getting it, correct? Okay. So again, you will prepare the T account, cash. Why did you debit the 2,000 cash? Because sales, when you recognize the sales, automatically you receive cash. Okay, when the problem is silent without stating any was this customers who borrowed from you, then you assume it to be cash when the problem is silent. Since the problem is silent, then it tells us that the sales are all in the form of cash. Okay, in this transaction. So cash of 2 million debited. Why? Because cash is an asset account. Next, sales. Sales, why do you put it on the credit side? Why did you put sales on the right side or on the credit side? Because sales has a credit balance. Normal credit balance of sales is on the credit side. Next, number 4 transaction. XYZ Company paid half to ABC Bank. It tells here that we will first disregard the interest. Okay? So, what are the accounts involved when you pay to the bank? When you pay to the bank, what are the accounts involved? Okay, cash. When you pay to the bank, the XYZ company will disburse cash. Okay? And then what is the effect of your payment to ABC Bank? Your liability will be decreased. Very good. Since the liability has a normal credit balance, okay, take note. Liability has a normal credit balance. If you will deduct or reduce your liability, you will do the opposite. Okay. Since liability has a normal credit balance and you will reduce your liability, you do the opposite. That means you debit it. Okay. And because you will be the asset also in the cash, it has a normal debit balance, but because you will be reducing your cash, because you need to pay to the bank, you will be reducing your cash. That means you will also do the opposite for the cash. If the cash or the asset has a normal debit balance of debit, a cash has a normal debit balance. If you will reduce, take note, if you will reduce your asset, what do you do again? You do the opposite. So when you reduce your cash, you will credit cash. Okay, let's do it on the journal entry. Okay, it shows here XYZ paid in half to ABC Bank. We will disregard first the interest. So, we said a while ago, we analyzed already a while ago, that notes payable is debited. Again, why is it debited? Because the normal balance of liability or notes payable is credit. But because you will reduce your liability, you will reduce your liability, you debit it. You do the opposite. So you debited notes payable because you will reduce your payable. May I ask you a question? When you pay to ABC Bank, what's the effect to your liability? Is it reduced or is it increased? Correct. It is reduced. You will pay to the bank half of your liability. So the effect is you will debit or reduce your liability by debiting it, or doing the opposite of credit through a debit. So you debit the notes payable. And again, why did we credit cash? Because cash is an asset account with a normal debit balance, okay? Normal debit balance. And because we will reduce your cash in XYZ because you need to pay the bank. So you will credit it. Do you get the idea? Okay. So in your T account, it shows like this. We mentioned in the previous account, in the previous transaction, that you incurred a liability here. You incurred a liability of how much? 500,000. So your normal debit balance here of liability shows here a 500,000. But because you will decrease your liability, you debited 250,000. So that is why you debit your 250,000 notes payable because you need to pay your bank. Okay. Next, why will you credit cash? We credited cash because we said that cash has a normal debit balance. But when you want to reduce your cash because of your payment to the bank, you have to credit your cash or do the opposite. What is the opposite of the debit normal balance? You credit it. Okay. So now you're getting it, okay? Number 5 transaction. XYZ Company bought 100,000 for equipment. Again, what are the accounts involved? When XYZ bought equipment, what did you receive? Very good. You will receive an equipment. But what will you give? Or what will you in return, what will you do? You will give 100,000 cash. So let's do the journal entry. Let's see again on your rules on debit and credit. When you bought an equipment, what happens? There is an increase in asset in the form of equipment. However, there will also be a decrease in another form of asset, which is called cash, because you need to pay for the equipment that you bought. Okay, so what is the entry? Okay, the entry is debit equipment because you acquired an equipment. Okay, that's an asset, and an asset has a debit balance. So you debit your equipment because it asset has a normal debit balance, and you will increase your asset account, so you will debit it. Okay, so debit equipment 100,000. But it says here that you bought that account. So, because you bought an equipment, you will reduce your cash, that which is also an asset account. So, to reduce your asset account, what do you do? Correct, you credit it. Okay? It has a normal debit, but because you will reduce it, you credit it. So, credit cash 100,000 because you will disburse cash, right? So, that means you will be decreasing your cash by 100,000. Okay, when you prepare a T account for that, you debit equipment. Okay, see equipment here, and you debited it by 100,000. Why did you debit it? Because you received an asset in the form of equipment, which has a normal debit balance. And then why did you put cash on the credit side? Because when you acquire the equipment, you need to pay, okay, the supplier of the equipment in the form of cash. So meaning when you pay cash, that means you will reduce your asset such as cash. So when you reduce your asset, you do the opposite of debit, which is credit account. So you credit your cash because you reduced your cash account by paying to the supplier of the equipment. Next, number 6, XYZ Company paid rent 70,000 and salaries 20,000. So what are the effects of this transaction? Number 1, you incurred expenses, rent expense and salaries expense. So when you paid the salaries and the rent expense, you disbursed cash. And cash is an asset account, and asset account has a debit balance, okay? Asset account or cash has a normal, look at this, normal debit balance, but because you will reduce your cash because you need to pay for your expenses, so what do? You do the opposite. You credit your cash. Okay? Okay, so let's look at the entry. So you credit, look at this entry. You credit your cash by 90,000 because you paid rent of 70 and plus 20. So you need to disburse. You need to reduce your cash, your asset account by crediting it. Why credit? Because normally it has a debit balance, but because you want to reduce your cash, you have to credit it. Okay. I hope you're getting it now. When to debit and when to credit. And because this is rent expense and salaries expense, we studied earlier that expenses, okay, it's here. Expenses have normal debit balances. Since expenses have normal debit balances, we will debit rent expense by 70,000, salaries expense by 20,000, and still your debits of 70 plus 20 is equal to your cash credit of 90,000. I know you're getting it by this time. So you debit rent expense 70,000. Why do you debit? Because rent has a normal debit balance, and you debit also your salaries expense because we said expense has a normal debit balance. Okay? Next, but because you have to reduce your cash, because you paid salaries and rent, you have to reduce your cash. What do you do with your asset, which is cash? You do the opposite. It has a normal debit balance. And then because you will reduce your assets, you need to do a credit. So you credited your cash by 90,000. Next, 7. Ben withdrew 50,000 from his investment. What do you mean here by withdrawal? Withdrawal means Ben would like to withdraw from his capital account the amount of 50,000. Again, what is the effect of this transaction, or what are the effects of this transaction to your accounts? First, what are the accounts? Withdrawal of expense? No, sorry, withdrawal of cash. And number two, your investment will be reduced. Okay. Now let's go into the rules. Okay. So expenses. No, drawing. Okay. It's letter D. Drawing is a debit normal balance. But because there was a reduction in the capital, when you withdraw from your capital account, that means your capital account is reduced. Nabawasan. Your capital account is reduced by the withdrawal of the owner. Okay? So you have, since capital is on the credit side, the normal balance is credit, but because you want to reduce it, what do? You do the opposite. You debit your capital, sorry, let us see. Your, yeah, you don't, sorry, my dear students, you don't have to credit your capital. Sorry, you don't have to debit your capital account because a reduction in capital account is through your drawing, which is already on the debit side. Okay, my dear students? Again, capital account is on the credit side, but you need not reduce your capital account because a reduction in the capital is already in the form of drawing account, and drawing account is on the debit side. Okay, so when you write the journal entries, then comma drawing, okay, because drawing has a normal debit balance of 50,000, and because the drawing will affect your cash, because the withdrawal of Ben through cash, you need to disburse cash from XYZ. So cash has been reduced by 50,000, which is an asset account. And to reduce an asset account, you do the opposite. You credit it. Okay. Next. Okay. So Ben drawing is a debit side. Okay. And cash again of 50,000. Reduction in the cash, so you credit your cash. Now, last transaction, I think, XYZ bought 5,000 for office supplies. So when XYZ bought office supplies, what does it mean? What are the transactions affected? Of course, cash, because you need to disburse cash when you buy the office supplies. And number two, you acquired a new form of asset, which is office supplies. Okay, so assets increased due to the uh, addition of office supplies, and then you will also reduce asset when you paid 5,000 in the form of cash. Okay, so there is a debit of 5,000 office supplies. Why did you debit office supplies? Because office supplies is a form of asset. Okay, your asset has been increased in the form of office supplies. And then if the other effect is you will reduce your cash by 5,000. So when you reduce your cash, which is a normal debit balance, you reduce it by doing a credit entry of 5,000. Okay. So when we do, now we will post the key accounts to your ledger. Okay. So the T accounts, each account has a ledger or a T account. We will call this the ledger of cash. Okay, the cash ledger or the T account for cash. We will now put all debit entries. Okay, the 1 million. Remember, this is the investment. The 500,000. This is coming from the money that you borrowed from the bank, and 2 million, I think this is the sales. Okay, then same with the credit side, all the credit cash account with the credit balances, you write it also on the credit side, and then get the total. 1 million plus 500 plus 2 million will give you 3 million 500. And on the credit side, 250,000, 100,000, 90,000, 50,000, 5,000 will give you 495,000. What is the next thing that you will do? Since the debit has higher value, so you minus or deduct 3,500,000 minus 495, you will get 3,500,000 3,005,000. Why do you put 3 million on the debit side? Because 3,500,000 is higher than 495,000. So you put the value of cash on the side which has the higher value. And since 3,300,500 is on the debit side, well, your 3,005,000, which is now the balance of your cash, is on the debit side. Okay. Next, the office supplies, there is only one entry. So there is a debit of 5,000. Equipment, there is only one account. So we encircle the 100,000 equipment. The sales, we have 2 million. Then we have the rent expense, 70,000. The salaries expense, 20,000. Notes payable. So there are two transactions. First, you borrowed money, that is the 500,000 here, and then you paid half. So when you paid half, what is the effect? You reduced your liability by 250,000. So since the higher amount is on the credit side, 500 minus 250 will be put on the credit side, because uh, when you get the balance, it should be on the side which has higher value. In this case, credit side has the higher value, so 250 is your notes payable balance. Okay, Ben capital is 1 million. Okay, next, Ben drawing 50,000. Okay. So after preparing all those the journal entries and the ledger, now we can prepare the balance sheet and the income statement. But prior to your balance sheet and income statement, we will be preparing first a trial balance. Okay, that will be discussed next meeting. So I hope you have understood the rules on debit and credit. Okay, now I want to say thank you very much for joining me in this class. And again, see you on our next meeting, on our next video of ABM with Teacher John. God bless everyone.